Hello and welcome to Switzer TV. I'm Peter Switzer. Now it's my birthday today and my video producer has COVID, so the program is going to be an all Zoom show. On tonight's show, June Bailu of Tribeca Alpha Plus tells us how she's investing in a banking crisis. And then I look at some of the top tech stocks that could rebound out of this banking challenge. So that's the show. Let's kick off now with June Bailu. Thanks for joining us, June Bailu.
Well, thank you for having me, Peter, particularly at this interesting time.
Yeah, it is interesting. How worried are you about the so-called banking crisis?
Look, at this point, not very yet. Of course, it's a moving feast. We're monitoring daily. But at this point, it does look like it's very much isolated to those problem areas, problem banks. Remember, many of those, they had their problem for years and they were they mismanaged. And clearly, during the environment where interest rates are a little bit tighter, it is going to be hard for those weaker players. So it seems well isolated. And it seems that central banks are very quick to jump and support those depositors and support the confidence. So at this point, I think it's well contained.
Yeah, now, obviously on the weekend or Friday American time, Deutsche Bank was put in the focus, and that would be a bank that you would be worried about if it had the same problems as Credit Suisse. What's your understanding about the position of Deutsche Bank?
Look, my understanding is really just a confidence issue. Deutsche Bank decided to buy back pay back a lot of its debt early before it's mature. And now normally it's a good sign of confidence, right? But the investors have taken that as very negative, thinking, oh goodness, there might be something behind the scene that we don't know. So of course, it certainly seems like a exaggerated move, and the investors probably just sell the rumors. Whatever happens, just sell first before asking any questions. Share price went down as much as 15%, but then it recovered somewhat. My view is that at this point, it certainly doesn't look like it's a widespread issue, and it's or any crisis that Deutsche Bank is facing.
Okay, so the bond market seems to be saying that they think that because of the bank crisis, and you throw in the extraordinary number of interest rate rises in a short period of time, that a US recession looks more likely than you might have said a month ago. Do you agree with that?
Look, I certainly do. Well, I do agree that US is probably facing a recession, perhaps at least a mild one. But even before this war in the past week of the events that's taken place, because our view is that the economy was running too hot in the US, and they certainly need to slow it down to a point where it needs to be a recession, a mild recession. It doesn't mean the equity market will crash. It just simply means the earning needs to rebase somewhat. I think it's absolutely right. Bond market and equity market sort of become a bit disjoint, and finally it does seem like bond market still started to reacting in a way that like what it should be during times of crisis, act as a bit of a safe haven.
Yeah. Do you think that, and you've implied it, if there is a mild US recession and then the central bank responds with rate cuts, that will soften the blow on stock prices?
Look, absolutely. We're already seeing the central banks now taking a softer approach. We heard from RBA, certainly sounds like they're going to pause for at least a month or so to see how the market and the economy digest the rate rises. And then we saw Fed. Previously, they were going to put out 50 basis points, and instead they put 25. So, all of these banks are now more pragmatic. They want to see how much tightening this event is creating in the real economy. I guess this is a silver lining. Interest rate perhaps will be on pause for some time.
Yeah. We also have seen a lot of big companies do some really big job cuts. And it seems to me, June Bailu, this is kind of like a prelude to a substantial slowdown in the US and maybe a recession. What's your take on that?
Yeah, absolutely. There's no way. Well, the only way to lower the wage growth is the increase in unemployment. It has to happen, and then the wage growth. Well, the employment market, which is way too strong in the U.S. and here in Australia as well. So we will see that take place in the next 6 months. And you should see unemployment going higher. But in the way, it lowers the average aggregate wage growth. Now, this is what we need to see for the equity market. We need to see inflation coming off, commodity prices are already coming off, and we need the wage to come off. And that means the interest rate may be done, or it won't be as much as previously expected. And at the same time, corporates and consumer not doing too badly, even though it might be a mild recession in the US. So net, it bodes a pretty good environment for the equity market in the second half of this year, once you rebase that kind of like earnings expectations and downgrades.
Okay, so in a sense, you're buying with the view that you might not get the big and better returns until later in the year.
Yeah, look, absolutely. I think it might happen, this market, you never know. It might be next month, it might be next week. The sentiment can turn just like that. My view is that the market looks pretty good. You will be buying the dip. China reopening is taking place. Some of those sectors and companies that were beneficial to the China reopening has now been sold off. So it's time, it's like almost like second chance to go back in and buy some of those. And then, some of the quality company, if it gets sold off during this sell-off, certainly should start buying into those companies.
Okay, people always love it when you name names, Junbei Liu. So what companies have you bought recently?
Oh, there's quite a lot of them. The number one is Dominos, certainly back into that value territory. It used to be a growth stock, now still a growth stock, but on the next 12 months. And then the value is really in the valuation, very cheap valuation territory. That one we bought more of A2, has been unfairly punished for Synlait's downgrade. And our view is that it's a license, its registration, China registration is going to come through perhaps in the next few weeks, or if not within the month. And I think that's a material positive catalyst. At the same time, companies still doing very well. So we bought more of that, and the likes of Ramsey in this environment is looking incredibly attractive. And again, Treasury Wine is another one that we think it's you should have in your portfolio.
Yeah. Do you hold miners if you think they're good value?
Yeah, miners, actually, we just started buying some more as well, because my view is that if China reopening is on track, it's going very well. You want to buy miners that has the China focus centric commodity. So things like iron ore is looking very attractive. And China, if you look at the investment, the corporate, a lot of forward indicators, the things are looking quite good. Even the housing market seems to be stabilizing there in China. So this sector actually looks very interesting. Every day when it gets sold off, it represents good opportunity.
Yeah. So when you do your company analysis, do you put a lot of importance, particularly when it comes to Chinese related stocks, what Beijing's saying, what Beijing's attitude is? Does that influence you to a degree?
Oh, look, you always put a higher discount rate for companies that if China is the sole revenue market, just simply because the risk is higher. You're selling to a market where there has been quite a lot of regulatory changes in the last 3 years. So things has been very tough for those companies. So, you need to apply a high discount rate. However, if you look forward for the next 12 months, it certainly seems like what China's focus is about growth. It's all about growth, growing above the 5% target. And with that combined, a lot of those companies with that kind of exposure, I believe with the share prices now more than offset with, cheap valuation.
Okay. Before I ask you, are there any stocks that you've sold recently? Let's go back to your first one, Domino's. Obviously, you would have pored over the recent reports, you would have looked at the balance sheet and its profit and loss and its earnings and all those sort of things. Why do you think the market has turned against Domino's, and what are you seeing, what part of the story are you seeing that tells you the market has overreacted and therefore it is good value right now?
Of course, look at Domino, the share price. It's quite incredible given the earnings. The share price being so volatile. We started buying Domino mid sort of September last year, where the share price was about $55, where we saw value. We know the near-term earnings tough, but for a growth stock like Domino's, it's all about longer-term store rollout and the addressable market. And in the last 12 months, things actually has been, outlook actually looks better for the longer-term story. So we bought it on that basis. Now, clearly, share price rally all the way to 72. For just, I don't know, investors become a little bit more bullish. Now, clearly, shouldn't have gone there because we know the result was tough. And when the result came, it went back down to kind of that $45, $50 mark. So now it's represent, again, very good buying opportunity. We just see the story hasn't changed. It's just really near term, it's going to get a little bit harder. And we know that. So you don't really buy a lot, Domino for any less than 12 to 18 month sort of earnings. And so, it's just stacked up really well in the current environment.
Okay. Finally, have there been any companies that you've recently sold that you don't think have the potential that you once thought they had?
Look, I think that there is quite a lot of companies that we sold mainly really to take profit, and so we can buy something else. Look, we really like Bramble, and we think it's done incredibly well. But relative to the market, it's up 20%. So it's done incredibly well since the result. We think there's more, price increases coming through. Expectations still not very high yet. But we just, we're not selling out, but we're just taking profit just because there's value presenting on the other side. Supermarkets, I guess, is another one we took profit in. It just, because we're seeing opportunities elsewhere. So net, it's really just finding better opportunity to a more efficient use of the capital and recycle some of them. So for the next 6 months, we'll get better.
Okay. Jimbo Liu, thanks for joining us.
Thank you so much.
And that was Jimbo Liu of Tribeca Alpha Plus talking about how she's going to invest in a banking crisis or banking challenge. Now, here's the question I keep getting all the time at the moment. It is, how are you playing the banking crisis? My answer is, I don't think this will be a serious crisis. And so I'm still betting on a growth and tech company rebound later this year. In fact, this banking crisis of confidence could bring US rate cuts in earlier than I thought. And that will help a rebound come earlier than it might have if central banks kept up with their madness of these excessive rate rises. Now, be clear on this. All central banks have done enough, and monetary policy, which works with a lag that can be anything between 6 to 18 months, will come in hard soon. I think the job cuts announced by the likes of Amazon, Google, Atlassian et al., and all show that the Fed's bark will soon turn into an inflation-killing bite. Now, the bond market is now betting on a 2023 series of rate cuts, and the expectation of a US recession has shortened. Now, this means we could see some dramatic market moments, but after they dissipate, the rebound will start with beaten up quality tech companies bound to be the target of the big players on Wall Street and around the world. I'm not alone on this subject, with analysts from JP Morgan telling CNBC that they aren't concerned about Deutsche Bank, and investors should focus on the European bank's solid fundamentals. I love this quote from the US central bank boss Jerome Powell last week on the banking crisis that started with the failure, of course, of Silicon Valley Bank and 2 others. This is what he said: in the weeks after such interesting events, it's often a bumpy road. He really is playing down the seriousness of this banking crisis. I think he knows the banking crisis fears will help beat down inflation, but he still raised official interest rates last week by 0.25%, and not the 0.5% that was expected before this bank crisis talk came about. But he was showing that he's not scared about a banking collapse like we saw in the GFC, and that's why he was prepared to raise interest rates. So I'm looking for the top 10 tech stocks that analysts like for the year ahead. And if they like them, it must imply that they agree with me that a tech and growth stock rebound is out there really waiting to happen. So I use something that IG Markets did last year, where they looked at the top 10 tech stocks based on market cap. And for each of them on this table I'm going to show you, I give you an idea of the average consensus rise that the analysts or the experts think. And I look at what the most optimistic analyst is saying about these particular companies. I actually ended up with 15. I'm going to share a number of them with you tonight. Let's go and look at the table. The first one is Block, and it is the biggest in terms of market cap. But you can see there that the analysts, despite some bad news around Block, and of course Block is the owner of Afterpay nowadays, and a company called Square. And the average rise there is 67.5%, and the most optimistic analyst thinks 72%. Now, at the moment, a company called Hindenburg is trying to short the company and has put some bad press out about Afterpay. Be interesting to see how this plays out. It probably creates even a better buying opportunity, provided that Hindenburg is not right in its negative view on the company. But from my point of view, I'm trying to show you that analysts like tech companies because they, like me, think a rebound is eventually going to happen. Let's go to one of our best tech companies, WiseTech Global. And there's already gone for substantial rises over the last couple of years. 7.3% is the average rise, but the most optimistic assessor of WiseTech Global sees a 41.9% upside for the company. Then there's Computershare. We often forget Computershare is really a tech company. The average rise there is 31.8%, and the biggest rise is 49.88%. Xero, of course, is a famous tech company. It's gone for a nice run lately. The average rise is 2.2%, but there are more optimistic analysts out there. One particular thinks there's a 20.5% rise. I think we'll see a much bigger rise for Xero over the course of the year. 2.2 looks very conservative. Well, 20.5% probably looks pretty well on the money. Another good tech company is Altium. There, the average rise is 9%, and this company has already experienced some good rises. But there is an analyst who thinks there's a 16.78% rise out there. Now, I'm not going to give you any more. If you want to know the rest of the companies I looked at, this was a story I wrote for subscribers to the Switzer report. So if you want to get the other companies, you're going to have to become a subscriber. But let me quickly run through some of the biggest rises of the other stocks that I'm not going to share with you tonight. NextDC, 29.22%. Another one is about 20.92%. Another one, 50%. And what about the sensational one? The rise there is 214%. You're going to have to guess which one that is. The numbers tell you a story that the experts / analysts see enormous potential in many of these companies. It tells me that we should take a tip or two from some of the world's best investors of all time. This is one from Warren Buffett. He said, "I will tell you how to become rich. Close the doors, be fearful when others are greedy, and be greedy when others are fearful." Quite a relevant thing to think about with the stock market a little bit under pressure right now. Another one from Carlos Slim Helú, who was the richest man in the world not long ago, from a Mexican telco. With a good perspective on history, we can have a better understanding of the past and present, and thus a clear vision of the future. He also said, courage taught me no matter how bad a crisis gets, any sound investment will eventually pay off. Paul Samuelson, the famous economist, he said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. For me, buying quality companies when they are cheap and being patient ultimately pays off. I think this is the time to look around for quality companies and then be prepared to wait. I think you'll like the results. That's the show for tonight. Thanks for joining us. Remember, if you want to know more about our company, go to switzerreport.com.au, become a subscriber, and you'll get access to some fantastic insights from some really well-qualified analysts when it comes to stocks. Thanks for joining us. See you next Monday.